Hey everyone, on one side while the Indian stock market is touching new highs, there is one particular sector that is touching new lows. I am talking about consumer durable space. For instance, Whirlpool of India share price is down 50% since January 21. Orient Electric share price is down 44% since November 21. Symphony share price is down 58% since January 18. Crompton share price is down 40% since September 21. And TTK Prestige share price is down 32% since November 21. Interestingly, these companies are fundamentally strong with very strong promoter pedigree and their product enjoys super brand status with leadership in the category. For instance, Whirlpool of India is a subsidiary of US-based company Whirlpool that is a global leader with more than 100 years of establishment. It's a leading player, especially in your refrigerator and washing machine category. Likewise, Orient Electric is part of prestigious CK Birla Group since 1978. It enjoys leadership, especially in the fan category. Then Symphony enjoys around 50% market share in the organized air cooler category in India. Crompton is again a 75-plus-year-old brand with strong presence in fan, light, home and kitchen appliances. Then TTK Prestige is again a part of very reputed TTK group with nearly 100 years of legacy and a household name in pressure cooker segment. The interesting part is that we all use the product from these companies in our day-to-day life. For instance, at my home, the fridge we have is from Whirlpool. Fan we have is from Orient Electric, including that exhaust fan. Then cooler is from Symphony. Water heater and iron is from Crompton. And pressure cooker is from TTK Prestige. So personally, I have a deeper connection with their brands. And I'm sure many of you would be using one or more products from these companies at your home. If you're using any of these products, let me know in the comments. Now, it is not that these companies have always underperformed. In fact, these companies have actually generated very good wealth in the past. For example, Whirlpool of India has generated nearly 16 times return between 2013 to 21. TTK Prestige has generated humongous 300 times return since inception till 2021. Symphony has generated more than 10 times return between 2013 to 18. Crompton generated nearly 4 times return between 2016 to 21. And Orient Electric actually got demerged in 2018 and generated around 3 times return till 2021. The question is, why these consumer durable companies have corrected so significantly for such a long time? And that too when the stock market has touched an all-time high. Is there a fundamental problem? And if these companies are fundamentally strong, have they bottomed out? Because if they have bottomed out, then it could be a great buying opportunity. If not, then when can they bottom out? In short, what is the expectation from these companies in the near term? So I tried to dig deep into this by going through the annual reports, investor presentation and con calls, and in this video, I'll try to answer some of these important questions. But before we begin, a disclaimer that this video is only for educational purpose. It's not a buy or sell call. And there is also a closed community of serious long-term investors on my website where I share one exclusive video every week, including my own investment strategies. You can also explore that. I provided the link in the comment. Alright, let's get started. Alright, so the first company is Whirlpool. It is a leading player in your refrigerator category and then washing machine category. Apart from this, it also offers your air conditioner, then ovens, water purifier, dishwashers. Now, if you look at the performance of Whirlpool over the years, before COVID, the growth was pretty decent, but then post-COVID, the growth has slowed down. From levels of 5,000, it is at around 6,500. So over the last 2-3 years, the growth is not that high. The interesting part is that look at the margins. Earlier, it used to command double-digit margin, and from then, the margins have reduced to 9%, 7%, now all the way to 5%. So this is one of the major culprit why its profitability has reduced significantly. From the highs of 667 crore, the profits have fallen all the way to 267 crore. And this is one of the major reasons why its share price has also underperformed. If you look at the reason for that, first reason management has mentioned in their annual report is the accelerated inflation in cost. Because of the higher cost, obviously manufacturing cost has increased, and second reason is the appliance demand has weakened. So on one side the cost has increased and on another side the demand has reduced. Apart from this, the second reason is mentioned is unforeseen weather conditions, especially for 2023. And then management has mentioned that the consumer durable market has become intensely competitive in last 12 to 18 months. This is important to note with respect to number of new entrant trying to scale up fast, often driven by low pricing offers or disproportionately high sales investment. Right? So this is again a reason why the performance has subdued. And final reason is significant changes in energy and regulation norm for refrigerators meant the entire refrigerator range had to be phased in and out in the first half of the calendar year. So I hope you got a fair sense of why there is the performance is subdued. Now if you look at the guidance of management, they said that the consumer durable industry in India witnessed a K-shaped recovery. Okay, basically what is happening is there's a stronger demand for premium products like your double door refrigerator, fully automatic washing machine and air conditioner, but the demand for mass products like your single door refrigerator, then semi-automatic washing machine is continued to be muted as the mass segment of the industry were hit by relative lack of growth of disposable income amongst the semi-urban and rural population. I hope you got a fair idea. And finally, as far as future growth is concerned, management has mentioned that demographic dividends is expected to drive economic growth and result in increase in disposable income. This economic growth, when combined with other factors like rapid urbanization, then meteoric rise of digital economy and some of the lowest level of appliance penetration in the world, should continue to spur demand for appliance across the spectrum. Now, as far as the H1 performance for FY24 is concerned, again, the growth has been not that high. If you look at it, June 23, it's 2000 crore versus 2000 crore of June 22, and September is 1500 crore versus 1600 crore of last year. So the growth has slowed down actually. Margins have struggled even badly. Earlier it was 6% and in latest quarter it's 5%. Due to that, the net profitability has reduced from 49 crore to currently at 38 crore on quarter basis. Right, so the recovery is not yet happened in H1 of FY24. Now, if you look at what promoters and institutional investors are doing, so promoter holding has been constant at 75%. And if you look at FIs, they've slightly increased their holding from 2.76 to now at 3.49. And DIs have also slightly increased their holding from 11.9 to currently at 12.9%. Public holding in the company is reduced slightly from 10% to 8.5%. So more or less, there's not much changes in shareholding pattern. But the good news is that majority of stake of the company is with your promoters and institutional investor. Only a small portion is with public. Next, if you look at Orient Electric, again a leading player, especially in your fan category. Apart from this, it also offers your kitchen appliances, then some LED lighting as well as your switch gears. If you look at the performance of Orient Electric, so basically the same story. It was at around 1864 crore before COVID, then jumped to 2000 crore. But since then, the growth has been sort of flattish in last 2-3 years. Again, same in trailing 12 months, it's 2669 crore. And the same problem, that is margin. So during pre-COVID, it was around 8-9%. And then during COVID, it touched around 11% peak. But from there, look at this, margins have fallen all the way to now at 6%. Right? And because of that, the profit before tax has fallen from highs of 160-170 crore to now at 126 crore. Because of weaker performance at business level, the share price has also taken the hit. If you look at the reason for this, so management has said that their profit after tax has dropped 39.8% in FY23, and the reason is because of the input inflation as well as ongoing investment in brand building and capacity development initiative for long-term growth. So two reasons management has mentioned. One is inflation, which is same as Whirlpool, and second reason is they are investing in brand building and capacity building, which is for the long-term growth projection. If you look at the individual category, lighting and switchgear business has witnessed strong momentum, but it's your electronic consumer durable that has been very flattish. It has actually declined because of lackluster consumer demand, commodity price inflation and moderate market growth. Fan business was impacted due to high channel stocking owing to BEE star rating transition. As far as future growth is concerned, they've forayed into high potential segment of wires and cables, although it is still already a highly competitive market. Then if you look at their focus, they're saying that the key focus of the company is on premiumization to drive company's portfolio expansion and margin improvement journey. Apart from this, they also want to leverage digital technologies across their operation, from enhancing their online presence, optimizing e-commerce capability to leveraging data analytics to gain deeper insight into consumer behavior. As far as their latest H1 performance is concerned, again, June number was 700 crore as compared to 600, and September number what, 560. So slight improvement in sales, but if you look at the margins are still on lower side. So earlier they used to command double digit margin, but then currently the margins are around 6% and 4%. Although as compared to the last year same quarter, there's an increase, but still the margins are on lower side. Now the same question on margin was asked to management, where they said that we have seen Orient in the past to do double digit margin on a sustainable basis. So how far we are in terms of getting back to that number, 3/4 or 4/4? So on that, management has said that not more than 3/4, ideally 2/4, but not more than 3/4. So I hope you get a good sense of when they can expect the recovery in margins. As far as the shareholding pattern is concerned, promoter holding is again more or less same, and FIs have slightly reduced their stake from 8% to 6%, now 5.69. DIs have slightly added the stake from 24 to all the way to 27, and recently in September quarter they've increased their stake to 29.98%, and public holding has reduced from 28.3 to 26%. Next we have Symphony, a leading player in air cooler segment across your domestic as well as your industrial application. If you look at the performance of Symphony, again same story. It was 1100 crore during March 2020 before COVID, and then look at this. It has been flattish, right? And if you look at the margins have fallen from highs of 19% all the way to 12%. So same story across all the companies in consumer durable space. They are all struggling with margin. And due to that, their profit before tax have fallen from highs of 230 crore all the way to now at 144 crore. If you look at the reason for this, again the reason is simple. Management is saying that despite commodity prices cooling off, headline inflation in India has not declined, and because of that the demand has been on weaker side. If you look at another reason is they don't just do business in India. So some of these companies, they also export a lot of their product, and especially they're saying that Australia has negatively surprised, and things have turned out unfavorable for them. Indian business has been doing well. They're saying they've registered 53% year-on-year growth, but overall if you look at the global performance, it is not that great. They're saying we record increase in logistic, material, after sales service and branding costs. So all in all, cost has gone up drastically, and because of that they're struggling with margin. If you look at the growth prospect, basically they're saying Indian cooler market is valued at $480 million and likely to double over the next 5 to 7 years, driven by factors such as rising temperature, rise in disposable income of middle class family, and ongoing process of rural electrification across the country. Then there was this question on guidance for in terms of revenue and EBITDA for FY24. On that, management has said that similar to all other consumer durable companies, they are not going to issue any guidance for the short term or medium term. Then if you look at the promoter holding is again more or less same. In the company, FI holding has actually reduced from 4% to 3.8%. DI stake has reduced from highs of 11% to 10.4%, and public holding has slightly increased from 11 to around 12%. Next we have Crompton Greaves, a leading player in kitchen appliances, fans, lighting and home appliances. Now if you look at its performance over the years, the growth is again the major concern. So it was around 4,500 crore in March 20, and then it increased to 5,000 and 6,000 and now 6,900. So the revenue of the company is not that bad. It is growing decently, but again the problem is with margin. At one point in time it commanded 15% margin. Before COVID it was around 13%, but now it has reduced to 10%. Because of that, the profit before tax has fallen from 724 crore to now at 577 crore. So same story. Their sales growth is not that great, and the biggest problem is because of margin, their profitability has reduced significantly. As far as mega trends are concerned, company has mentioned that some macroeconomic trends include increasing urbanization, growing per capita income, increasing share of women in workforce, and rising focus on sustainability. Apart from this, there are a lot of government initiatives like accelerated electrification, cooking gas increase in coverage, then potable water availability and development of affordable housing. So all these factors are expected to drive the market in the long term. Then if you look at the management guidance, they are saying that they've embarked on Crompton 2.0 journey, where the focus is on premiumization, then go-to-market excellence, then brand investment and new product development and innovation. So more or less this is the same story for all the company. They are focusing on premiumization and investing in new product development and innovation. Then if you look at H1 performance of Crompton Greaves, again not that great. If you look at it as compared to previous 2 quarters, the growth is not there and the margins have actually further reduced from 11-12% to now at 10%, and because of that their profitability has struggled. And then if you look at the guidance, management has said that we do not want to provide a forward guidance. Okay, so because of that we don't get a clear indication in terms of what we can expect in the next 1 to 2 quarters. Finally, we have got Prestige, a leading player in your pressure cooker, mixer grinder, gas stove, cookware, and a lot of other home and kitchen appliances. Now, if you look at the performance of Prestige, it was around 2,100 crore before COVID, and from there again the same story, the growth has been flattish. As far as margins are concerned, it was around 14% before COVID and actually increased to 16%, but the recent margins are as low as 12%. So same story, margins have fallen drastically. Because of that, their profits have fallen from highs of around 300 crore, 400 crore to all the way to around 300 crore. Right now, as far as management guidance is concerned, there has been volatile and uncertain global environment that has continued to exist in the current quarter, which is Q2, and there is headline inflation that has continued to come down in many countries, driven by decline of food and energy price. However, the core inflation, which is excluding the most volatile component, energy and food, hasn't significantly slowed down. Right? As far as future prospects are concerned, going forward, both Dussehra and Diwali festivals falling in third quarter coupled with low base for Q3 of last year, the growth in consumer durable industry is expected to be better in the coming quarter. And the continued effort by the company to expand its customer base for export, the export sales should grow once the global economy revives. Okay, so and then if you look at the shareholding pattern in Prestige, its promoter holding has been again same at 70.4%. FI holding is also more or less same at 8%, and DI holding is also more or less same at 13%. Public holding is at around 8%. So one thing I have noticed is in majority of this consumer durable company, promoters have got significant stake, and not only that, even FIs and DIs have got a good amount of holding in these companies, and public holding is on lower side, which is a good sign. Finally, if you look at the overall picture in terms of the market cap and valuation, so currently Whirlpool is trading at around 1314, commands a market cap of around 17,000 crore, P ratio is 85, and from the peak company has corrected 50%. Orient Electric trading at around 216, market cap of 4,600 crore, a P ratio of 57. Correction from peak is 44%. Symphony trading at current price of 880, market cap around 6,000 crore, P of 52, and correction from peak is 58%. Crompton Greaves, current market price around 300, market cap is 19,000 crore, P ratio is 44, and correction from peak is 40%. Finally, Prestige, current market price around 770, market cap is around 10,800 crore, P ratio is 47, and correction from peak is 32%. Please note that in spite of 30 to 60% correction, the P is looking at higher side, and the major reason is because the earnings have fallen significantly. Once the earnings would improve, when the margins would do well, I think that the EPS would go up, and when EPS would go up, P ratio should fall. So overall, if we conclude, the biggest takeaway from this exercise is that the major reason why consumer durable companies have corrected between 30 to 60% is due to inflation. It resulted in weak demand that impacted the top line and also resulted in high input cost that impacted the profitability. So basically, consumer durable companies have faced both supply side and demand side challenges. Another reason for correction is due to increased competition. Today, all the established players in the consumer durable segment are expanding their product portfolio, and that has made the market highly competitive. Moreover, many new players are also trying to make an entry into this consumer durable segment, and that is also putting a lot of pressure on the profitability. Then another factor I have observed is these consumer durable companies have always commanded a premium in the past, and this current slowdown in growth made their stock valuation expensive. So that was also a major reason why they have corrected significantly. Although fundamentally, all these companies are looking strong. Now going forward, in the near term, we don't have any exact clarity in terms of revenue and profitability, as these companies don't give guidance. However, for the long term, there's no doubt that consumption is one of the key themes in India. If people are going to construct new houses, or if people are shifting from small town to metro cities, there would be demand for consumer durables like your fan, fridge, washing machine, kitchen appliances, and so on. And one key theme for future is premiumization. There is growing demand for premium products in consumer durable space that include smart devices using the IoT. And finally, sustainability would be a major focus area in terms of lower power consumption. These companies are already working on premiumization theme and launching new products to expand their portfolio. Now it would be interesting to see how these companies come out of current challenges. It seems we might have to wait for a couple of more quarters, but this correction has certainly created opportunity. Has the bottom been made? Well, I think partly yes. There can be another 10-20% correction here and there, but more or less, I don't expect a significant correction in consumer durable stocks from current levels. Of course, everything would boil down to their future performance. So I'll keep a close eye on the results. Till then, I would let you decide whether you find these consumer durable companies attractive or not. I hope you got a fair idea behind the correction in their share price. Finally, just want to conclude by saying that it takes a lot of effort to study so much and create a well-researched content. So I hope you will appreciate my efforts. And if you find this video useful, do share it with your friends. I'll see you next video. Till then, take care.